Well, good morning, everyone. Thank you for joining the conversation. This is Carlo with Stablecoin Solutions. I'm going to take a moment to make sure that I share this link to everyone who signed up via the Luma link. We are live talking about the Genius Act, from law to launch, what we can expect going forward. I'm very, very delighted to have an amazing panel on the stage with me today to break down what is happening with the Genius Act and what we can expect going forward. I think there are more questions right now than answers, and that's why I put this together. I wanted to bring some of the rock stars from the sector who are literally in real time unpacking all of this and give everyone an opportunity to share in the conversation. I want to pass the mic to Caitlin first to introduce yourself to everyone. Caitlin, tell them who you are. I'm sure many already know. Thank you to everyone who joined. Caitlin, please, the mic is yours.
Good morning, Caitlin Long, CEO of Custodia Bank. We have had stablecoins in our business plan since 2020. We were granted the first of what is a patent portfolio on stablecoins in 2022. And we issued the first bank-issued stablecoin with our bank partner Vantage in March.
Excellent. Thank you for joining the conversation, Caitlin. All right, let's kick it to Zack. Zack, introductions, please.
Hi, my name is Zack Shapiro. I am the managing partner of a digital asset-focused law firm called Reigns LLP. I'm also the head of policy at a think tank called the Bitcoin Policy Institute based in DC, where we educate policymakers about what we think good policy looks like with regard to Bitcoin and increasingly stablecoins as well. So excited to be part of the conversation.
Excellent. Rob, good morning. Thank you. Please tell the folks who you are.
Morning or afternoon here in London. Rob Hadick. I'm a general partner at a fund called Dragonfly. We're about a $4 billion fund. We've invested in around everything in crypto, stablecoins, and everything in and around stablecoins has been a broad focus for us for the last 5 or so years. We've got quite a bit of investment in the space, and so great to be here. And thanks for having me.
Excellent. Thank you. Anthony, good morning.
Good morning. Anthony Bassili, president of Coinbase Asset Management. We are a wholly owned subsidiary of Coinbase Global. We manage money for institutional investors. We help them invest in the digital asset ecosystem. And we are very focused on the emergent market structure for stablecoins and the opportunities to drive alpha therein. So it's great to be here with you all.
Yes, thank you. Finally, John, welcome.
Hey, yep, John, founder and CEO of a company called Bank Social. So we build the majority of what we do is build infrastructure, Web3 based infrastructure for financial institutions, namely community banks and credit unions. And we have what we call a cooperative liquidity network. It's a tokenized network interoperable with all the Fed, ACH, International SEPA, SPAY, PIX, as well as a peer-to-peer or bank-to-bank money movement here in the United States. And we launched a couple of stable coins for a couple of financial institutions around the country over the last about year and a half. And, we're seeing just a tremendous outpouring of interest over the last probably 4 or 5 months with regard to regulated financial institutions getting involved heavily in DeFi. I think, Anthony, you and I were in a roundtable up here at the Bank Social offices about 3 or 4 months ago with some really cool individuals and some great conversations on this exact topic.
That's right. Good to see you again, John.
Awesome.
Yes, sir. You too.
Well, we've got a rock star panel, and I think it's an important and timely conversation to have because, number one, I don't think people fully understand the significance of what just happened with the passage of the Genius Act. It's what inspired me to launch Stablecoin Solutions as a consulting agency to help onboard people. I think at a minimum, people need to understand that fully regulated stablecoins are going to open the door to moving money at the speed of the internet and to break reliance on banks as being sort of the juggernaut for fee extraction, for delays. What does this mean for the consumer? What does this mean for family offices? What does this mean for companies? Caitlin, you have been a trailblazer in this. So I want to pitch it to you first to share your thoughts on the significance of the Genius Act, and then we'll kind of transition into what we can expect going forward. But just how important is it that we actually got this off the ground and signed into law?
Well, it's crucial because created regulatory clarity. It achieved a very important policy objective for the US Treasury, which was to legitimize a new source of demand for T-bills, mostly coming from offshore stablecoin issuers. And that particular new source of demand is price insensitive and not likely to dump their T-bills in a panic. And that is of value to the US Treasury. So that doesn't have that much of an impact on the domestic market, but let's face it, that was the real policy goal of this. And in terms of the domestic market, really, it's upgrading the 1970s payment rails that still are heavily used in the United States. I believe that stablecoins will, in the next 5 years, make a big inroad into not just ACH, but Fedwire as well.
Awesome. And you talked about what the ultimate end game is here, and I have to agree with you. I think Scott Bessent understands the critical importance of getting stablecoins right and how important that is to not only demand for treasuries, which he needs the world to buy treasuries, and also dollar stability. So we had Russia come out recently and be very critical that we're essentially dumping stablecoins on the world to erase our $35 trillion debt. And, I can't disagree with that. They basically said the quiet part out loud. If Bessent can pull this off, this is going to increase interest in treasuries. This is going to increase demand for dollars. But Anthony, I want to kick to you for purposes of considering other global implications of fully regulated stablecoins, because we're also about to enter what everyone believes to be a huge rate cut season. We've got that first rate cut coming out very soon. And then we've got President Trump positioned to replace Fed Chair Powell, bring in somebody more sympathetic to his economic vision, and what this might do to Treasury and interest rates. Treasury rates are what stablecoins earn their living on. So if we see a decrease in interest rates and Treasury returns and the yield on these Treasury returns, what do you feel like that's going to do to stablecoin growth and to dollar stability?
Well, I think there's two things going on here. So on the first level, this is just a massive technology enhancement for money. And so Caitlin already referenced that. So we're going to take the capital efficiency of our US economic system and eventually the global money system, and we're going to improve it by an order of magnitude. So that's the first thing. So you're going to see a lot of dollars that just sit around idle for 2-3 days, maybe even weeks, based on accounts receivables and accounts payables, delays that are now going to be more efficient, and they're going to be used in the system. So productivity enhancements, all right, things are going to speed up. We're going to save on cost for a lot of people. That's going to happen over time. The second thing is the geopolitical implications that you're discussing here, which is from Scott Bessent's perspective. He's quoted as saying that stablecoin industry will go from 250 billion or so where it is today to 2 trillion by 2030. And this is an immense amount of money that's going to come into a product category in a very short period of time. So two things happen from that. One, the opportunity to invest in that particular sector from a technology perspective is better than many in any other sectors, right? It's not often you see trillions of dollars flow into a particular sector that fast. The implications there to your first point, which is if stable coins earn their interest margin from the treasuries they hold that back them, which is part of the way the law is written, where you underwrite them today is going to be very different than where you underwrite them in 2 or 3 years from a valuation perspective. So I think that's something that's really important to discuss, which I know Rob probably has some good opinions on, which we would dig into. And then there's the debt of the U.S. government, right? So $37 trillion in debt today, and that's going nowhere but up. And I guess the question there is, does the feedback loop really work? If we're successful in exporting dollars in this incredibly efficient technology wrapper to the rest of the world, are we also going to be able to export US dollar debt through that? And that's the great question, right? So I think there's a lot of different threads to pull on, right? The profitability of the technology, the companies building in there, the geopolitical implications of really what is US versus China rivalry, and how that intensifies. And then you can't forget about just how many people are we going to help around the world who are currently sitting in maybe war-torn nations or just poor geopolitical climates with even worse currencies than our own. And that's a really important topic to talk about too.
Maybe I'll
Thank you.
take a little of a different angle at this as well, and agree with
Please, Rob.
most of what Anthony said here. But I also think you can tell that most of these stablecoin issuers, which they're the ones affected by the rate cuts as we started this conversation, they're trying to figure out how to horozontally expand and how to monetize in different ways.
Yep.
Yeah, and that's the real thing you're starting to see right now. You can see it with Circle. They launched the Circle Payment Network. They announced ARC, right? That's something that clearly they're trying to figure out a way. Okay, in the future, do I monetize on call it BIPs, right, on transaction volume, and do I look more like potentially a payments business, right? You've seen it with like people like Bridge, who Bridge was actually an orchestrator, or they were doing cross-border payments first, and then they launched their own stablecoin, and now they're launching a white-labeled stablecoin that they're looking to do for MetaMask and for Hyperliquid and some others. And so you've started to see what a lot of people who are building around stablecoins are using the stablecoin as a wedge product to do a bunch of other things and to sell in other ways. And so as that kind of continues to expand, I think we'll talk less about stablecoin issuers as their own kind of siloed business, and we'll talk more about businesses that use stablecoins to do money movement.
Yeah. And you've been covering closely on X. I've seen you comment on the hype craze right now. Hyperliquid has launched a massive proposal where their Discord's getting flooded with all kinds of different proposals for executing on their stablecoin, and yield is part of the conversation. And as we know from having dug deep into the Genius Act, consumers are prohibited from earning yield, and banks are prohibited from paying out yield, I should say. Consumers can earn yield, but banks cannot pay it out directly to consumers. And banks have been very vocal about trying to lobby Congress to close up what they regard as a loophole in the Genius Act in order to prevent people from earning yield on stablecoins in the DeFi sector. That is something that's not getting enough attention right now. I don't know how much traction that's getting in DC, so I want to kick it to you, Zach. From purposes of the DC and policy perspective, what are banks trying to accomplish here? It seems like they want to close this loophole because they want to maintain their fee extraction model, and they want to limit consumers' ability to earn on stablecoins in DeFi. What are you seeing on the ground in DC with respect to that?
Well, to very quickly answer the bank question, I think this is more or less naked protectionism. I mean, this is like when the automobile came out, the sort of big horse lobby got laws passed in a lot of cities where you had to go in front of an automobile and wave red and yellow flags to make sure that no one would get hit by cars. And eventually that becomes impractical. And I think that the current prohibition on yield really is a concern about flight of deposits. But I think to frame this maybe a little bit better, I've maybe a more skeptical view of what the Genius Act is going to do, or is, at least could do, than maybe some other folks here. And I think it's important to sort of separate out into the near term, sort of less speculative consequences of the Genius Act, and then what we could see in the future. I think the things
I love the contrarian view. Bring it.
Well, I think the things, I don't know how controversial it's going to be. I don't think it'll be that controversial, but I think what we can say for now with a pretty high degree of certainty is, one, the Genius Act, once fully implemented, is going to be good for consumer protection in the United States, particularly with regard to the requirement of sort of one-to-one backing. I actually don't think that's a necessary requirement, and I hope they relax it long term. I don't know why we couldn't have reasonable fractional reserved stablecoins, but for now, there's a lot of concern that a lot of the really around Tether, it's not fully backed. It's going to collapse despite all the evidence that Tether is like the most profitable company in the world. So I think this will do a lot to instill consumer confidence. I think the other really big sort of non-speculative impact of the Genius Act is that it gives longer term regulatory uncertainty to non-crypto native institutions to get into the stablecoin game. Now, one interesting consequence of that is there may be increased competition for the industry incumbents like Circle and Tether. So far, I mean, after Circle's IPO, they seem to be a huge beneficiary of this. They clearly had a big role in the specific language of the Genius Act, but I wouldn't be surprised to see some, maybe sort of late to the party, but TradFi entrants that are going to alter the competitive landscape. Then I think the question is, what kind of product market fit do stablecoins have? I think aside from Bitcoin, stablecoins are I think basically the only thing in the digital asset industry I'd say has really meaningful product market fit now. It's just better than an international wire. If you ever tried to move money internationally, I'd much prefer to get USDC than an international wire for my overseas clients. But how much farther will it go with this regulatory certainty? There are two routes it could go. One is sort of as a back-end payments rail. I think you use the term money moving at the speed of the internet. If institutions adopt stablecoins as their rails, right? Companies like Robinhood, companies like Stripe, this could just lead to more efficient infrastructure than the sort of SWIFT or FedNow systems. But then there's also the potential for front-end user-facing product market fit, which could be for peer-to-peer payments, although apps like Venmo are pretty good right now for that stuff. But eventually, perhaps an alternative to banking, right? If you have to go into a bank branch, God help you, it's just an awful experience, right? Trying to move your own money. The bank doesn't share a lot of yield with you either. And so I think it is in that context not surprising the banks are sort of looking out. And we don't know if stablecoins are going to reach this level of adoption, but if they become a more compelling sort of hybrid savings and payment vehicle, why are a lot of people going to have just regular old checking depository accounts if stablecoins are accepted everywhere? So I think this is legitimate fear from the banks. That is why they don't want yield. I think eventually the better technology will win out. There will be yield, and I do think banks will lose depositors, but it's not an unreasonable, unfounded concern by the banks.
No, you absolutely nailed it. And John, I want to pivot to you because you're actually talking to banks, and you and I had a chance to visit a couple of weeks ago in Dallas when we had that dinner with Hester Peirce from SEC, and we were talking about the fact that banks are still, I think, especially smaller regional banks, largely oblivious to what's happening with stablecoins and the power. I've talked with people at banks, and they don't get it. They look at me with glossed eyes, and part of I think the problem here is that they're slow to adapt and they're slow to understand just how disruptive fully regulated stablecoins are going to be. So can you talk from your perspective about having visited with banks about trying to integrate this technology, and what are you seeing on the ground there?
Well, it's the same thing that happened with the internet in the late 90s, early 2000s. All these banks that were slow to adopt. I mean, how many news articles did you see about the internet is going nowhere? We're not putting money online. We're not creating digital deposits. That same thing's playing out right now. We do see a tremendous number of front runners here in the space. Tokenized deposits. We haven't really talked about that, but we do have some institutions that are tokenizing deposits that are starting to give yield on those. We have some that are going as far as taking loan portfolios and turning those into smart contract based loan portfolios and then tokenizing yield and return out of those and making that interoperable with USDC, Bitcoin, and so I think we see that there is a huge. I think the Genius Act really did what you said, which was it legitimized their need to pay attention. And until that came out, what we saw, I mean, just a staggering fact here. For the last 2 years, I mean, we've grown to about 40 institutions that utilize our systems over the last 2 years, but just in the last 3 months, since the Genius Act has been on the tip of everybody's tongue, we've had that many more contracts go out in the last 3 months than we have in the whole last 2 years. And so I think what you're seeing is I agree with Zack. I agree with everybody here. I think Zack, you hit it on the nail on the head when you said it's gonna create better discovery for technologies that benefit people's lives to have a chance to win. Now there won't be centralized ownership of opportunities for ways to drastically impact people's lives. And so I think that's why your community banks and your credit unions are taking a lead here, because that's been their MO the whole time. As opposed to, I'm not going to name names here, but those are really the people those are really the institutions that they're small enough to be nimble. They're small enough to move fast. They're small enough to I will also say that their regulator in the NCUA, and even now Rodney Hood moved over to the OCC. You've got Travis Hill. They're all really making a push. And the NCUA came out 2.5 years ago as the first regulator on record of saying, go forth and conquer with DLT technology. So I think we're in the perfect time to allow for discovery to proliferate in the form of may the best May the best version of value creation for the people win.
Love it. Caitlin, I want to go back to you because there is a provision in the Genius Act that allows for state level sponsored stablecoins. And Wyoming, your home state, front ran my home state, Texas, in launching what appears to be the first test of that. Now, I think it's important to stress for everyone out there that there is no such thing as a regulatory compliant Genius Act stablecoin right now, because yes, the law's on the books, but we're still waiting for the regulatory rollout. The effective date of the act is technically in 2027, unless the regulators bring to Congress their proposed regulations and that all gets approved. Am I wrong? Because I see you nodding your head. No, because there's a lot of ambiguity about this.
Yeah.
People think it's already in action, but we don't have an application process. We don't really have a regulatory plumbing down yet to do this. So you
At the
are
federal
very
Isn't there
much
a
on
grace
the ground
period?
on
There's
this.
a grace.
Talk to me.
Yeah, at the federal level, you're right, but that's not true at the state level. There are grandfathered permitted payment stablecoin issuers. Those of us who have issued prior to the passage of the Genius Act are grandfathered. So
Right.
you're right to talk about that there is a state solution. There is a misperception out there, if you go read closely, that state regulated stable coins have to become federally regulated at 10 billion. That's not true. There is a pathway for the states to be deemed by the US Treasury Secretary to be equivalent. I forget what the actual term is. If their state
Right.
regulations are equivalent to the federal regulations, then state chartered issuers can stay state chartered above 10 billion.
So regardless
they're-
of the 10 billion threshold, they can
Correct.
stay as long as they maintain, I guess, parity with the Genius Act.
Correct. Yeah, but it has to be certified by the U.S. Treasury Secretary. But the point is that this did not blow up the dual banking system. They were very careful in the drafting. And by the way, that's not an accident because, as you pointed out, Wyoming led the way in all of this. And the person who drafted a lot of that is the same person who drafted Wyoming's laws when he was working for the Wyoming legislature and then the Wyoming Division of Banking before going to work for Senator Lummis. So it's not an accident that those things are there. And he's very committed, and Senator Lummis and frankly, the Senate Republicans on Senate banking, very committed to preserving the dual banking system. So I think that's an important distinction. And so you're absolutely right. We do not have any federally deemed permitted payment stablecoin issuers, but there are New York and Wyoming entities, and possibly Nebraska, that are permitted payment stablecoin issuers that were grandfathered in.
And I think that's absolutely huge. And I wish Texas would wake up to this because they passed digital asset legislation. I think if they just make some regulatory tweaks, if you're listening out there, Texas, happy to talk to you about that.
We'll talk to Abbott. We'll talk to Abbott at the TBC at the summit.
There's a lot
Good.
going on in Texas, though, Carlo. I can't talk about it yet. I know there are a lot of rumors because a lot of conversations have happened, but something big is happening in Texas, and it's being driven by Custodia and Vantage. And when it becomes public, which will be relatively soon, I think it will cause a lot of people to turn their heads and say, "Whoa!" And I'm not going to front run that by getting into how we're doing that, but we have been working with both the Texas and Wyoming banking divisions since before March, which is when we announced that we issued a bank issued stablecoin with Vantage for the first time. We've done 3 issuances total. We haven't announced anything since June, but that's because we've been working and we're getting pretty close to announcements. And what you can read into our press releases is that everything we did was blessed with proverbial regulatory holy water. We did not do anything unless we actually had, in our case, written approval to do what we did or supervisory non-objection. And the Fed is involved as well. Now, we haven't talked yet about the Fed. The Fed is still, its most virulent anti-crypto and anti-stablecoin regulation is still on the books. It has not been overturned. That was released at the same time, literally the same minute as the Custodia denial in January 2023. And it was voted on by the Board of Governors 7-0. famously, the board of governors right now is 5-2 against the Trump administration. So 2 of those 7 who voted for that have obviously become more friendly, but there's still a majority of the board of governors that is opposed to Trump, and therefore I think that pretty much obviously explains why that regulation has not been overturned yet. And that is an interesting fact because it prohibits banks from owning digital assets as principal. So that means a bank can't own ETH even in a de minimis amount to pay gas fees for stablecoins. There's some pretty major implications of the fact that regulation is still in place and has not been overturned.
We have a lot of work to do. Anthony, I want to kick it to you because we've talked a lot on the institutional level. You know, you service a lot of institutional clients, and I've attended presentations you've made to registered investment advisors and so forth, talking about the power of crypto and the unlocks of stablecoins. I mean, I have talked with you extensively about what I believe stablecoins can do for family offices for purposes of moving money, getting in and out of deals faster, not having to rely on Monday through Friday banking, the fees that come with ACHs, the delays, the currency conversion issues. From the institutional side, what are you seeing as far as traction and interest in onboarding stablecoins?
Yeah, I'm happy to jump on that. I do just want to give a shout out to Anthony Apollo in Wyoming and just how awesome it was that he stuck to his guns and, you know, got this done at the state level, which is huge. I know it's not easy. So it's very cool to see that. And, you know, Caitlin, excited to see what you're coming up with in Texas. I am in Texas, so maybe you can call me after and give me the inside scoop on what you guys are working on. So what are we seeing from clients? You know, I think the reality is so I spent 4 years in the institutional business and then recently now I've taken over the asset management business. And so my remit has changed a little bit in that, you know, it's less about trying to help people use the technology now. We're more focused on investing in it and the opportunities there. But what I would say is it was a pretty long slog to try to get corporates, for example, to, you know, really onboard and start to use USDC and have them think about cross-border payments and transactions across their global entities in a way that really drives the efficiency. It takes a little bit of time to get over that initial hump and hurdle of using the technology. But once you do, gosh, it just changes everything, the entire dynamic about how you think about your business and your personal finance. So with regard to investors, I think it's less of an investor conversation for the RIAs. It is interesting to say that our funds, for example, you can subscribe to them with Bitcoin, with USDC, or with US dollar wire, right? So, you know, this is a big innovation for the investment industry in that we didn't tokenize our funds, but we can handle crypto payments. We can handle crypto subscription for those products. It doesn't require us to go and reformat the entire LP agreement in order to be able to use the underlying digital currency in what it's meant for, right? Which is to buy things, right? And so if you're buying an investment product on our shelf now, you can do that with digital assets. So we think that's a huge innovation. It allows us to build products that serve crypto native customers, right? So whether they're self-custodied or they're using a qualified custodian or a state custodian, it doesn't matter. If they're holding value in digital assets and we want to be able to support that particular thing as a means of payment, we can do it. And that's the beauty of the interoperability of this technology is we're not going to be beholden to only taking a wire from one particular type of bank for our products.
Excellent.
So I think that's the biggest unlock. And you're going to continue to see the market really evolve and adapt around understanding the nuances of taking one token or currency versus another. I think that's, in my mind, one of the biggest opportunities from an investment standpoint today is going to be how are all of the new issuers going to build their integrations into different ecosystems? How are they going to incentivize their particular stablecoin to be utilized in an ecosystem? You mentioned the hyperliquid RFI that's going on right now. You've got 7 or 8 major stablecoin issuers who are coming in looking to be the sponsored dominant stablecoin behind the scenes for that network, right? Because there's $5 or $6 billion of assets that they could easily win if they get selected. And I think we've only just scratched the surface in terms of the issuers thinking through their strategies for go-to-market and how they're going to get their products adopted into different ecosystems. So we're watching that space really closely.
Thank you. Rob, I want to kick it to you because one of the interesting facets about building in the stablecoin space is the overseas interest in entering the U.S. marketplace. You know, Paolo at Tether pulled off an interesting acquisition in getting Bo Hines on his team as an advisor, which I think is setting up, from a strategic standpoint, Tether to try to enter the U.S. market with a fully regulated and Genius Act compliant stablecoin. For purposes
they actually
of
announced that during this stream. So the launch event was at the top of the hour. So
thanks for front running me, Paolo. That's amazing. So the interest is there. Just as we had talked about with Caitlin about the state level stablecoin parity, in order to launch in the United States, the way I see it in reading the initial Genius Act, and we don't have any regulatory clarity, but just reading the letter of the law, you've got two options. You either need to partner with a bank or a bank charter that is compliant, or you need to come from a nation state that has parity with the Genius Act. Am I on the right track there in how that's going to unfold? And how do you see that? Are we going to see, I predict we're going to see tons and tons of stablecoins, many of which may not make it because they just don't have network adoption. Like Anthony had said, that's a critical part. But do you see a lot of overseas interest in building over stablecoins in the US?
Well, I think
okay. No, go ahead.
Oh, I was going to say, I think as you mentioned, Carlo, there's one real unknown here, which is how the OCC is going to view foreign regulatory regimes for the purpose of the Genius Act and what they're going to consider parity. So that could be a really high bar if we're going to have it be more or less analogous to the Genius Act in the United States, or it could be a significant lower bar. If it's a lower bar, then I suspect there's going to be a huge amount of interest in building overseas to get the benefit of maybe being able to add different types of collateral to the stablecoin, maybe having less than a 1-to-1 reserve ratio overall in your main stablecoin treasury. You still can't offer yield if you're a foreign issuer, so that will be consistent. And then I think the additional thing to mention is if you are a foreign stablecoin issuer and you are going to offer stablecoins in the United States, you do need to have onshore accounts with sufficient US style collateral to cover your US users. But if you're a giant company, right, and you can hold higher yielding instruments than you're able to hold with the sort of US domestic collateral requirement, I actually think that is going to be a really attractive option, either for foreign companies or really anyone who wants to set up a popular stablecoin and go out a little bit on the risk curve with their collateral. Yeah, because the brands are coming. Rob, jump in, please.
Yeah, maybe I would just add a little bit. So Tether obviously is kind of the elephant in the room, right? They announced I think everyone kind of knew it was coming. I was supposed to be at the launch event, but ended up having to travel, unfortunately. But they announced their stablecoin today, and it is actually wholly different than what they do otherwise. So their attestations that they put out, they're not audits, but attestations that they put out for USDT otherwise, it shows that they have they're collateralized by Bitcoin, and they're collateralized by, and at times have been collateralized by like loans and things like that. And so not what would be Genius Act compliant collateral reserves. And what they announced today, and I don't have full details, but it seems like they're issuing a completely likely to be Genius Compliant Act compliant stablecoin that is issued by Anchorage, who has this kind of quote unquote Genius Act as a service product, and that will use Cantor Fitzgerald as its reserve manager, right? And so what are they showing you? They're showing you that they're less concerned, or they don't want to disrupt their offshore business. They want to keep that as is. But they want to come into the U.S. as well, so they'll just do something different with a different collateral base, a different issuer structure, et cetera, right? Now, Tether can probably do that and do that, maybe profitably because it has a brand and people know who it is and has this size. I think that's going to be really hard for, call it, other startups or other technology companies to come in and do that. And I'm also not sure that Tether will be successful here in the U.S. because there is so much I think belief in some of these other stablecoins that have been issued here. So It's not clear to me that there will actually be a lot of foreign stablecoins coming to the US because most of the market for the stablecoins right now are outside of the US, right? They are things like cross-border payments. They are things like disrupting the correspondent banking system. They are things like providing dollar access to emerging markets. We're seeing a lot of pickup in things like shipping and commodities settlement and treasury management for global corporates. Like these people all want US dollar denominated stablecoins, but most of the usage of them and most of where they're sitting is actually not onshore, it's offshore, right? And so maybe some big corporates or some big companies will issue their own stablecoin that are global, and they'll want to bring that to the US. I think we'll see some of that, but it's not clear to me that there's as much demand to go that way as there is demand to go the other way.
Interesting. John, you're an OPSEC guy, and you're talking with financial institutions about safety and wallet structure. And one of the unanswered questions in the Genius Act is, yes, you've got to have reserves, and there are protections for consumers. It's very consumer forward as far as what its agenda is. However, there are still some unanswered questions about how consumers can actually get to their stable coins. Because if you look at the terms and conditions of like Circle and a lot of the other sponsors, buried in the terms and conditions, there are certainly things that may not be completely aligned with Genius. And then you have the issue of, in the event of a mass liquidity event, we've seen it before. We saw Circle depeg briefly. Consumers can access their Circle, but as I understand it, a lot of this liquidity is held in centralized exchanges. So there isn't necessarily a very smooth path in the event of a liquidation event, Silvergate, the things we previously saw. Will consumers be in a log jam trying to get their stable coins off in the event of a problem because the stablecoin sponsors are not necessarily holding those stable coins, so they've got to be on at the reliance of these other exchanges that are holding? And are there solutions that you're exploring to solve for that?
Yeah, so I don't want to speculate as to what will happen, but you certainly named what has happened in the market and how the market has reacted to those types of events. And I think we have an opportunity to build more resiliency with the way these new tools can be deployed. We have an opportunity to build more resiliency. Just as an example of this, we've got what we call our cooperative liquidity network that distributes funds across a number of institutions, tokenizes those dollars, and then allows those dollars to be moved around. The majority of the liquidity in the world, regardless of if we like it or not, is where it's in banks, right? It's in financial institutions, and so we have to release a lot of that liquidity, because the lack of movement of that liquidity. I made a note here that we get so many questions about, my people want to move money with Venmo, or my people want to move money with Zelle, or my people want to move money with Cash App. Well, what we're seeing is actually the evolution of that same exact mindset. But now, instead of saying Venmo or Zelle, you're saying ETH or Bitcoin or USDC. So the wallet, the mentality, the idea of a wallet is changing substantially. And I think freeing up liquidity and allowing for the base liquidity to still remain in, I'm not saying that I think the federal financial banking system is the optimal way to fractionalize money and to create markets, but certainly going back to what we were talking about before, and allowing these new ecosystems to find some equilibrium with the advancements of these technologies and the participation of where the most liquidity is going to move us forward into these directions. And then from an operational and security perspective, one of the things that from the bank's perspective, and this is what's always fascinated me about these systems, is the ability to monitor where money goes, the ability to now with the advancements of AI, we're wrapping AI with DLT, and not just proving provenance, but proving, network effect attacks. We're able to identify and operationalize things that 5, 7, 10 years ago you couldn't even fathom. And when you talk about how that reduces fraud, or that reduces risk, or that reduces, pig butchering and phishing scams and all these other things that are top of mind for the everyday person, top of mind for these financial institutions that literally every year they just go in. I don't know if I've been fortunate enough to see P&Ls and balance sheets on boards and advisor to some of these banks, and they just write off 25%. They just approve 25% for fraud loss next year, as long as it stays below that. And so the opportunity to not only provide more resiliency to the network in the forms of liquidity distribution, but to also reduce and to harden and strengthen these ecosystems at the same time as making them interoperable is really where I think the banks are most focused. And this is where, to me, you get the neck. Nobody really cares. Like my mom, she wants to be able to move money fast. She wants to be able to participate in these systems, but nobody knows how an ACH moves at most of these banks. Maybe two people at a bank know how an ACH. Caitlin, you and I probably know. Maybe Zack, Rob, maybe we all know on this call how an ACH works, but nobody really knows how an ACH works. But to be able to not just revolve to another financial tool, but to evolve these systems and take advantage and leverage all the interoperability and security that they provide is really where we see the primary focal point of these institutions. And that's how we free up the vast amounts of liquidity that are sitting at these banks that can be utilized to provide so much more value around the world. So we see a lot of banks. I mean, I'll just one quick story here. I was down in Bolivia. I utilized my embedded wallet in a financial institution to buy some Tether. It was in an airport, the duty-free store, and you couldn't use credit cards. They didn't even take cash. They didn't even take the Boliviano. They didn't want anything. They just wanted USDT. And so I moved the money right from my bank account right to USDT, and I went and I scanned the QR code and paid the guy. So these are the types of things that are proving to, while small, be the primary use cases that are driving the interest of the banks and of the community banks and the credit unions.
Excellent. Thank you, John. Caitlin, do you foresee that stablecoin issuers are going to get access to Fed Reserve and be treated like banks? That's another lingering question that we don't have answers to. We know that Treasury is hosting a roundtable coming up soon. We know that they've opened up some comment, but there's still a lot of unanswered questions. Do you foresee that fully approved stablecoin issuers are going to be introduced into the Fed Reserve system similar to banks? Will there be that kind of parity?
No.
Expand.
Because stablecoin issuers are not legally depository institutions. There's been a rush to get trust company charters, and there have been several now who have applied for Fed master accounts, and the Fed master account system, you have to legally be a depository institution in order to use the payment system. Let's step back. What is a depository institution? It is a financial institution that is legally authorized to accept a US dollar deposit. A trust company by law is prohibited from accepting a US dollar deposit. To be able to use FedWire and ACH, the Fed has taken the position that you have to be a depository institution. So a trust company may be able to use trust services like storing T-bills in a Fed master account. There's precedent for that, although not clear that that's even legal. But the Fed has historically given some trust companies access to Fed master accounts, however, not for moving money in the payment system. What's the value of moving money in the payment system? It's the par guarantee. This is why ultimately we saw so early that you have to be a depository institution, and that the stablecoin market, I firmly believe, will go entirely to the banks. That doesn't mean that crypto companies won't themselves become banks, but right now there are exactly 3 of us that are banks, and we're all Wyoming special purpose depository institutions because by law we are authorized to accept US dollar deposits. The Nebraska DADI charter is not legally a depository institution, therefore not eligible. All these trust companies, including OCC trust companies, also not eligible to get access to the payment system for moving US dollar deposits. That is where the distinction is. And I have had very extensive conversations with the actual decision makers, and I believe firmly that that is ultimately where it will come down. So these trust companies stops that several crypto companies are in the process of making right now are intermediary stops. That's great. That gives companies the ability to do business nationwide. if they have not been able to do so, they don't have to do the 50 state money transmitter licenses. So there are benefits to getting, for example, an OCC trust company charter, but getting access to FedWire and ACH at the Fed, you've got to legally be a depository institution. And I firmly do believe, with very good, very recent conversations with decision makers, that the Fed is not going to change that.
I'll
Yeah,
second
look,
that. I love you, Caitlin. You're awesome.
Yes, awesome. And look, I'm going to kick it now to Zack because we're waiting. We're trying to figure out where this is all going. What would you do as far as advising clients right now while we're in this kind of holding pattern with respect to Genius Act and how it's going to unfold? Now's the time to prepare, obviously, but what would you advise clients to do to prepare?
Yeah, I mean, I think it really needs to start with careful thought about what your business model is and where stablecoins fit in. I mean, my current view is that it looks like it's going to be a pretty heavy lift to do your own stablecoin. It's going to be a hugely competitive market. And so, a lot of my clients are early stage. And, the first conversation we have is, at the intersection of business and law, like looking at the regulations as they are now, as they might be. Does it make sense for you to get directly involved? Does it make more sense to do picks and shovels? Where is value accrual going to be in the stablecoin space? And I think the best thing you can do now is not about granular, compliance with the regulations, because we don't really know what that's going to look like yet. It really is on the business side. It's where you want to be positioned for what's coming. The current regulations and the plain text of the Genius Act give some good hints there. But I think you really need to start with where is it you want to be seated for what is coming next, and related to that, like what is your particular view of how this market is going to play out? Because like I said before, I think that's pretty unclear, and different people have different levels of conviction on what stablecoins are going to be adopted and used for, who the market winners are going to be at the high end. And so I think, in terms of positioning, it's careful thought about what is your edge and what is your view of what's coming.
Excellent. Okay, I promised I'd keep this to about an hour. So I want to give each of the panelists an opportunity to sort of talk about what, number one, you see a successful Genius Act looking like on the back end. And number two, if you had your dream list of what you would ask regulators to change or to improve upon the text of the Genius Act, what would you propose? I'm going to go to Anthony. First of all, thoughts on where you see this all being once we are live, and if you had any dream asks about how we could improve this, what would they be, Anthony?
Oh, you're going to start with me, which is probably the worst decision you can make. I feel like my perspective is a little bit sitting back and watching the market play through its competitive forces, and which is fascinating to see. I think Caitlin's views are really prescient, right? Which ultimately it comes down to safety, security, and soundness of the dollar and protecting consumers. And so that's probably the most important thing to think through in terms of how this plays out, right? Which is at some point you're going to get down to the granular level of going, how do I trust hundreds of millions, billions, and then trillions of dollars in stablecoin format? And how do I trust that I'm going to have the ability to handle, volatility shocks, which do happen and will happen, right? So number one thing there is going to be how that plays out. I think we've heard, Governor Waller, he's said openly that he thinks he would like all stablecoin issuers to have access to the Fed window, right? Which then moves, it changes the conversation around how banks.
He did say that. He did say that. I was there when he said that.
Oh, there's a distinction. Be careful.
Agree.
Right.
I
Yeah.
agree with you, Caitlin. I agree with you, Caitlin.
There are details here where that sound bites just don't capture the level of distinction and how the actual connectivity to the Fed system happens.
It's incredibly nuanced. So, that's probably the thing that I'm most focused on, aside from the jockeying around who's getting their products listed where and how they handle distribution, right? It's going to come down to what does global scale actually look like, right? When this thing is pegged to the dollar. So that's probably my answer there.
Thank you, Anthony. Rob, your thoughts on those 2 points?
Yeah, I'm going to say something that is maybe among this group less popular. I think the history of technological innovation, in my mind, does not happen in the banking sector. It happens outside of the banking sector. The banks are usually the last ones to get in adopting really new technologies. Caitlin's obviously a bit of a outlier to that. Been trying to launch regulated stablecoins in her bank for a long time. But when I think about what the opportunity is for this technology to bank the unbanked, to allow for dollar access to people who haven't had that before and who have inflationary currencies, to move money in real time without having to have 15 or 7 correspondent banks in the middle, to just get rid of a lot of the I would call it fat within the call it cross-border and correspondent banking system. I think if we want to really proliferate quickly and we want US dollars in the hands of people worldwide, we are about on the edge of what will be a currency war. And I think we're in a cold currency war already with China, right? And so if that is true, then we need to move quickly. And if we need to move quickly, then the Genius Act needs to allow for tech-enabled issuers and providers of stablecoins who are not necessarily regulated banks in the US. And we need to be able to push that globally. That's maybe it doesn't answer the specific question that you asked, but I think gets to the things that I would like to see, which is I'd also like to see yield programmatically. Every single treasurer you talk to will tell you that if I can get programmatic regular yield at real time, like that's going to change my whole business, right? If I can do things like having cross-border money movement and settlement in real time and not have to necessarily fit that within my normal bank flows, like that's really powerful for those people, right? And so all of that said, I'm really focused on a way of which we can do things like provide yield and we can allow for the non-bank issuers to proliferate.
Excellent. Thank you, Rob. John, you get to make your ask and your prediction. Go for it.
Oh man, well, I ask that they continue being, I actually appreciate that they've been very light-handed. I think that, as opposed to dumping thousands and thousands of pages on it, I appreciate how they've been a little more light-handed on issuing regulation and guidance. And so, and law, right? I think we've seen more guidance and regulation than we have law to this point, but I would just ask them to keep working in that manner and be light-handed with this. I do agree with a lot of what Rob said, that certainly allow for markets to self-stabilize and to find novel ways to get to market. But I also believe that there are enough the first digital banking app, the first way to digitally move money was, our one of our board members, USAA, the CEO of USAA, they invented that, right? The first digital remote check deposit was invented by a small community bank who had people all over the state that couldn't. So I think there are innovators who will step forward and who will help. I think when we see banks and securities brokerages down in Latin America, for example, who want to hold dollars, certainly they're willing to experiment a little bit with stable coins and things like that, but they actually we find them be a lot more adoptive when there are regulated financial institutions backing these currencies, backing these rails. The idea of an FBO account now is very old, and some of what we're talking about just kind of advances the way FBO's account can work in more real time and be more liquid. And so I think really the idea is, and my partner Becky says this a lot, she's a former financial institution CEO, and really a lot of what we're doing is the same as what we've been doing for a long time. It's just layering new technologies on top of it for the most part. I mean, there's some novel stuff that's happening out there, but those are really whenever I talk with, the chair people of these organizations, mostly the regulators, we mostly talk with the regulators, not so much the lawmakers, although we do talk on that side. But, I do think it needs to be a mix of both in order for us to move fast, in order for the adoption to happen. If we want the dollar to win, it needs to be a combination of both happening, because the big money movement, the big opening of liquidity is going to happen with trust. It's going to happen with regulation. I mean, look at what's happened with the Genius Act. Look, there have been many stablecoin issuers, and yes, they do billions of dollars, and they have a lot of tokens issued, but the vast majority of the liquidity unlocking is now happening, that regulated institutions are getting involved, that regulations and that laws are being passed. I mean, that's just the reality of how people think because of the risk of going the other way. And so I think that encouraging private public regulated and unregulated partnerships in this and making it easier for those to happen so that people like Caitlin, so that people like Anthony, Zach, Rob, myself can get in here and work with these institutions that are forward looking to help innovate at speed and not hit all these roadblocks that we've traditionally had due to just heavy regulatory hands that don't really do anything except stifle innovation.
Great points, John. Zach, the lawyer on the panel, bring it. What do you think?
So my ask would be for regulators to recognize that the reason why stablecoins are valuable in the first place is that they run on peer-to-peer blockchain rails. That is what is better about this technology than using centralized intermediaries. And I think the Genius Act does a pretty decent job of separating out the issuers who are regulated under the Bank Secrecy Act and regulated as financial institutions, and leaving alone, for the most part, the peer-to-peer rails where stablecoins trade, secondary between individual participants. And my ask is to make sure that that stays the case, because otherwise you kill the golden goose. That's what this is all about. That's what makes this useful. And then my prediction is if we do that correctly, right? If we allow stablecoins to find whatever product market fit that they find, whatever commercial use cases they find based on the inherent peer-to-peer nature of blockchain technology, then stablecoins are going to serve as a powerful on-ramp for other freedom technologies like Bitcoin and decentralized finance. I think it's going to do that in part just because of the sort of Overton window shifting and legitimizing this as a form of moving money in a way that people can understand without having to take sort of scary price risk on Bitcoin or cryptocurrency, and because people are going to see just how much better, how much of a pleasure it is to use this compared to dealing with intermediaries. And so, I'd hope if we can do this right, I think that will be the outcome.
Love it. Caitlin?
Here, Zach. A big believer that these are stablecoins are on ramps into Bitcoin. And to answer your question, Carlo, the ask is for the Fed to repeal that regulation that's still in place. The prediction is that when that does, or even if the Fed just de facto ignores it and wink, wink, nod, nods to the banks and says, just go, the real volume in all of this is not what we're talking about with crypto markets, with DeFi, with stablecoins. The real volume in all this is with the banks. The FedWire processes $1.1 quadrillion of payments. And stablecoins is 250 billion. ACH processes 87 trillion. Stablecoins are 250 billion. So, and I do believe, watch what Vantage and Custodia are doing. We've been working very closely with regulators, and the holy grail is figuring out how to connect into tokenized bank deposits, which can pay yield, and which bring this technology to the traditional banking system flows, and then also connect them to stablecoin markets in a safe and sound way. Nobody is playing in that market except for Custodia and Vantage. Watch, we'll have some announcements.
And Bank Social, hey, Bank Social too, Caitlin. We've got a couple use cases.
Everybody's pumping their bags. I love it. Listen, that's amazing. Look, this has been a great conversation, and I want to just build on this in the final point and say, I have firmly believed that for the consumer perspective, when they wake up to the power of stablecoins, you look at businesses and what this will do for businesses and their ability to pay vendors, to process payments, to move money globally, and to break the fee monopoly that banks have. Yes, it's going to be very disruptive to banks. It disrupts their traditional fee model. It may cut into their customer deposit model, which is largely fractional reserve, and how they make their money, lending our money out and making more interest on it than they're paying us. This is all wildly disruptive stuff. But in closing, I have to agree with Zach, and I have to agree with Caitlin, and I think everyone collectively, stablecoins are going to be the Trojan horse that's going to onboard millions of new wallets and consumers into cryptocurrency. Because once they realize just how empowering fully regulated, pegged stablecoins are going to be. They're naturally going to then explore other opportunities with respect to other cryptocurrencies and bridging those stablecoins over to other cryptocurrencies and playing in the DeFi space and earning yield. And this is only going to bring greater network adoption to digital assets. So in closing, I think we all collectively agree it's critically important for the United States to get this right for dollar dominance, for Treasury stability, and for the digital asset sector. It's critically important that we understand and we fully integrate stablecoins, because that is going to be the mass adoption event. We are digitizing money and moving it at the speed of the internet, and I don't think there's any stopping this. I genuinely want to thank everyone for joining this conversation. I hope to bring more of these, and I invite anyone in the sector who wants to have a conversation with me about what they're building in the stablecoin sector to please DM me on X and let me know what you're talking about, what you're building. And I'd love to bring that conversation onto a video format so we can continue to educate consumers, because at the end of the day, that's what's critically important. We're not going to get that mass adoption without the consumers understanding just how powerful this is. So, Caitlin, Zach, Anthony,
Thanks all.
Rob, John, thank you so much.
Thanks for
Have a
having me.
wonderful weekend, and we will all
Thank
hopefully
you.
talk soon.
Thanks,
Thank you so
Carlo.
much.
Good work.
Have a great weekend,
pleasure.
everybody.
Bye-bye all.